There are index funds, mutual funds, exchange traded funds. Which one is the right choice for you? Well, today I'm going to go through each one of them and help you make a better informed decision on what is the right investment decision for you. Now, all three provide greater diversification than what you would get if you were to invest directly in individual stocks. Okay, let's start with the index fund first, because that is essentially the building block for what we're going to talk about today. An index fund is a vehicle that is either a mutual fund or an exchange traded fund. Now, if you haven't seen my video on what is an index fund, I highly recommend you watch that video now. So an index fund is designed to replicate the performance of a particular index. For example, the S&P 500. Now, keep in mind the S&P 500 or the Dow Jones or the NASDAQ, they're all paper indexes. They're hypothetical indexes. For you to be able to gain exposure to those indexes, you would essentially have to buy all the stocks in the S&P 500, for example. So if you wanted to replicate the S&P 500, you'd have to buy each of the stocks in the S&P 500, which could be A, very time consuming, and B, extremely expensive. But the index fund that was introduced in 1971 by Wells Fargo for the first time, it gave investors the ability to be able to buy a fund that mimics the S&P 500 or the NASDAQ, whatever index it is that's underlying. It gave investors the ability to mimic the performance with one investment, and usually at a much lower cost than if they were to buy the index directly. So the index fund itself is an investment vehicle to be able to gain exposure to a index in particular with an underlying index such as the S&P 500. So now that we know what an index fund is, now let's pivot over to a mutual fund and talk about what a mutual fund is. So a mutual fund is a pooled investment vehicle that pools money from many different investors for a specific purpose. And let's use, for example, Fidelity as an example. Fidelity has a mutual fund called the Magellan Fund. And the Magellan Fund was run by this person by the name of Peter Lynch for many years, from 1977 to 1990. Peter Lynch ran this fund. So Magellan would collect funds from investors and it would invest it into this Magellan Fund, and Peter Lynch and his team would decide how those funds would be invested. And their goal was to do capital appreciation. So they had a very broad range of what things they could buy. They could buy U.S. small companies. They could buy international stocks. They could buy U.S. large companies. They essentially bought the companies that they thought that they're going to do well. Now, a mutual fund could also be an index fund. If a mutual fund is an index fund, there's no manager involved. The mutual fund essentially buys the assets of that particular index. And I'll continue to use the S&P 500. So Fidelity also has an S&P 500 fund. And in that fund, there's no fund manager. There are no investment decisions. The money that's pooled to invest in that Fidelity S&P 500 fund are essentially invested entirely in the S&P 500 and then mimics the returns of the S&P 500. So as you can see, a mutual fund can have essentially two different objectives. It could either be a mutual fund that's actively managed, where there's a manager or a group of managers that decides what stocks are going to invest in, or it could be a mutual fund that's an index fund where it pulls all the money into a particular index. S&P 500, Dow Jones, NASDAQ, whatever the index would be, that mutual fund's objective is to mimic that particular index. Now, mutual funds do have some disadvantages. One of the disadvantages of a mutual fund is that they're not very tax efficient. What that means is during the year, a mutual fund pays out capital gains distributions that cause you as the shareholder to pay tax on it. So let's assume, for example, you just bought a mutual fund, the Magellan Fund. And by the way, I have no interest in the Magellan Fund. I'm just using it as an example. But let's assume you bought shares in the Magellan Fund. You put $100 into it. And during the year, Magellan Fund sold Apple stock that it purchased many, many years ago. And because it bought it many years ago, it's got a capital gain. Well, that capital gain has to get distributed among all the shareholders in a capital gain distribution. So at the end of the year, even if you didn't sell the Magellan fund that you bought for $100, you would still get this taxable event that you have to pay tax on that capital gain distribution. Now, that causes the mutual fund to be very tax inefficient because it's triggering a tax liability for you, even though you did not cause that tax liability. Another disadvantage of a mutual fund is that it's only traded once a day. So at the end of the day, at the net asset value of the mutual fund, that's the price that every buyer pays and every seller pays to get in or out of that mutual fund. So that's a big disadvantage, that it only trades once per day. Another disadvantage of a mutual fund is that you cannot hedge or do options on the mutual fund. Meaning if you wanted to bet the direction of a Magellan fund or a American fund or a Vanguard fund, mutual fund, you cannot do that with an options contract or any other derivative instrument. And then lastly, one of the other disadvantages of a mutual fund is they tend to have higher fees than exchange traded funds that I'm going to talk about next. Now, the only time a mutual fund is not going to have as high fees is if the mutual fund is an index mutual fund. In that case, because it's not paying a manager, it's essentially mimicking a particular underlying index, the fees associated with that fund are a lot less and very comparable to what you would pay on an index fund through an ETF. Hey, if you like these videos, please remember to like, subscribe, and share our channel. And if there's a video or topic that you want us to cover, be sure to include it in the comment section below, and I'll do a video on it in the future. By doing so, you're helping us create more content and growing our channel. So now let's discuss the Exchange Traded Fund. The Exchange Traded Fund was first launched in 1993. And it's very similar to a mutual fund, but it's actually better than a mutual fund. And I'll go over some of the advantages of that. Now, the largest ETF that's out there, the largest exchange traded fund, is the SPY. The SPY, that's the ticker symbol. And that exchange traded fund is one that tracks the S&P 500. Now, there are a lot of exchange traded funds out there that track the S&P, or they track the NASDAQ or the Dow Jones, but the SPY is the largest one out there that's extremely liquid. There's millions and millions of shares that are traded on a daily basis. So now let's go over some of the advantages of the exchange traded fund. One of the biggest advantages is its tax efficiency. I mentioned earlier that a mutual fund has capital gains distributions, which makes them really tax inefficient. But an exchange traded fund has very minimal, if any, tax capital gains distributions, which means that they're very tax efficient. Now, exchange traded fund does have dividends or interest that's paid throughout the year. And even if you reinvest those dividends or interest, you still have to pay tax on them. But it's nothing like the capital gains distributions that occur when you least expect it and they cause a taxable event for you. Another big advantage of an exchange traded fund is that they're continuously traded throughout the day when the market is open. So when the market is open, just like you do with a stock, you're able to do a stop order, a limit order. You can do short selling on it. You can't do any of that on a mutual fund. So the exchange traded fund has a big advantage over the mutual fund because it allows you to do that stuff throughout the day, more advanced trading strategies and tactics. Another big advantage of the exchange traded fund is that some of them, or most of them, have options contracts on them. The more volume a particular ETF has, the greater the opportunity for an options contract on it. Now, the options contract allows you to be able to do hedging strategies or take directional bets on an ETF. So for example, the SPY, as I mentioned earlier, which is the largest S&P 500 fund out there, if you wanted to buy an options contract because you thought that the SPY is going to do really, really well next month, you could buy an options contract that would allow you to buy the S&P 500 and to hedge against that perceived upward in the market. And you can also do the same thing if you thought the S&P 500 was going to go down. You can buy an options contract on the SPY that will allow you to do that. Another advantage of the exchange traded fund is that you can use them as collateral for margin. So let's assume you had $100,000 worth of an ETF that's an S&P 500 ETF, and you wanted to use that as a margin, as collateral to buy some more investments, whether if it's stocks, bonds, or other exchange traded funds. you can do that and you can use that as collateral. You can't do that with a mutual fund. So that's a big advantage that an exchange traded fund has over a mutual fund. So I hope you found this video helpful in the differences between an index fund, a mutual fund, and an exchange traded fund. And hopefully you're able to decipher which one of those investments are the best ones for you.